Welcome to Moffat on Money. I'm Clay Moffat, and I'm glad to be with you here today. We've had a fair amount of activity on the site these past few days, and I've got to give credit where credit is due. A huge shout out and thank you to Rob at Law and Lumber. He spoke extremely graciously of this channel and encouraged his viewers to subscribe. Many of them have. We are humbled and really grateful for his kind words, his encouragement and support, as well as the willingness of his viewers to subscribe. Our goal, Chunk, Tallulah, myself, is to give you information that helps you become a more knowledgeable person as an investor, to better care for yourself and your family. Family is everything. But Law and Lumber gave us a huge boost. And Rob, I owe you a scotch, man. Not the cheap stuff either. So thank you. Now, today we're talking about FTX. I've seen several broadcasts over the past few days about FTX being some sort of crypto killer. Saw one that argued that FTX was even put into place, was designed by some grand power to destroy crypto. So we'll enter this discussion. We'll talk about it. We'll hopefully with some constructive thoughts, ideas, some little bit better information. We'll look at all the hullabaloo about FTX, what FTX actually did, and its implications for crypto in the future market. Tallulah and Chunk are in the corner reminding me to ask you to subscribe and hit the like button if you like the content. Or if you don't like the content, hit that like button really hard. Take your frustrations out on it. So let's first examine crypto. Now, I talked about crypto in my first couple of videos, a little bit about Bitcoin in the first two videos. So if you want more detail, start there. But let me try to give you a brief synopsis. If I can talk. Crypto is digital currency or money. It originates from a computer program that produces the coins or the tokens. These tokens can then be exchanged over the internet for goods or services. Coins are produced either at first when the computer program is written and first starts running, or over time by the program in a process called mining. And many of you may have heard of mining. Mining is done by a computer on the network. Each computer on the network basically serves as a bookkeeper. It keeps a ledger of accounts and transactions, much like your checking account. When you look at it, you can tell who deposited money, when, where the checks were written, who the money went to, when it was cleared. Check all the bills and transactions that have occurred in that account. Well, that's what the system does on each computer. Each computer keeps a ledger of the entirety of transactions, and the system rewards these bookkeepers with payment in coins, which the owner of the computer can then spend to buy goods and services, spend as money. So yes, crypto does serve as money. Now, how the coins are produced is actually a critical component in knowing whether or not crypto has some value, or whether it's a scheme or just a black hole waiting to be discovered by unfortunate, uninformed investors. So we can differentiate this critical component into two different broad-based systems, CeFi and DeFi. Now, CeFi is short for centralized finance. CeFi is what we've had for hundreds of years. You know, you've got a central bank, central location with one set of books or a computer that all the data, all the transactions are stored on. And security is obviously a very big issue, because if somebody hacks into this, and it has happened repeatedly down through the years, if somebody hacks into it, they can change the accounts. They can move money around. They can hide it. They can create dark accounts, whatever. Hack that, and you can do most anything to the information there. The Original crypto was Bitcoin, which ran on a blockchain system and basically created the DeFi system. There is no centralized accounting computer in a DeFi system. No one computer has the info. Instead, every computer in the system has the same ledger. If one computer's ledger differs, is altered or changed to make it different from the rest of the computers in the system, that one computer is thrown out of the system. There are millions of computers, for example, in Bitcoin's blockchain system, making it virtually unhackable. If somebody wanted to try to hack the system, they would have to be able to hack millions of computers simultaneously, which is pretty much impossible. So the production of Bitcoin is inherent in the system. It's set up, it's unchanging from its inception in 2008. We know there will only be 21 million Bitcoin produced in total by the system. It's still producing it, will produce it through 2040. That schedule is known, how it's produced, how much is produced is known. So there's no surprises, no alterations to the system. It's pretty much immutable as far as systems go, computer systems go. Government can't make less or more. Individuals can't make less or more, no matter how expert they are in the system. To change it, you need over 1/2 of the computers in the system to agree pretty much simultaneously. Chances of that are slim and none. So the real difference is that a good DeFi system can't be hacked, can't be whimsically altered or produced. The coins can't be produced like it can in a CeFi system. That's why Bitcoin can't be fraudulent, why it's really not used in criminal activity that much. Criminals need secrecy. They need to be able to process tons of cash. They need to have things hidden from the consumer or their target, whoever, and particularly hidden from the law. Well, Bitcoin doesn't work like that, doesn't really allow that. So a good DeFi system is not necessarily a encouragement to criminal activity, as some would try to make it out to be. Now, those strengths of a DeFi system are exactly why Sam Bankman-Fried, created his own coin or token. He could control the production, he could control the sales, he could control the amounts revealed publicly. He could change the price or influence the price strongly if he wanted to, accordingly. You can't do that with a DeFi system, only a CeFi system. And, I kind of argue that crypto is the future. And kind of proof is that almost every major Western central bank is looking at creating their own cryptocurrency, their own coin, a central bank cryptocurrency, CBCC. So you'll see a lot of people talking about that. The reason is crypto is simply a better system for executing transactions efficiently, and efficiency, usually ends up winning. That's the great appeal to Bitcoin. The problem with Bitcoin, as far as central banks are concerned, is they don't control it. They don't control the money supply. They don't control any aspect of it. They want that control. They're not willing to give up that control over money supply. In addition, a cryptocurrency would give them precise information about an individual's activity, their interests, their preferences, offer huge information value to central banks and governments. It also would allow them to control how and what you spend ultimately. It also ensures that taxes will always be collected and that taxes can be raised even quietly. You could raise it a fraction of a percent a day or a week or a month, and nobody would ever know. Or most people wouldn't know or be aware of it if it was a CeFi system. So I guarantee you it's coming. It is the future. Now, some people argue that, it can't be valuable because it's just zeros and ones on a computer. Well, I could also argue that money can't be valuable because it's only paper. or technically linen, if you want to use that. Things are valuable because of one reason and one reason only: people's perception. People perceive it to be valuable. Now, money, for it to be valuable, people have to perceive it, even though they're not thinking necessarily in this terms, they have to perceive it as a store of value that I talked about in the first video. You exchange your labors for this money. Money is a medium of exchange. I don't have to go to the bread maker and tell them I'll give him an hour of my time for a loaf of bread. And he goes, no, make it an hour and a half. And I go, but have a rare talent. Let's do 45 minutes. You don't have to do that. You know how much you're willing to exchange your labors for, and you can then translate that using that medium of exchange into actual purchases. I'm willing to give up this amount of my labors via the medium of exchange for this product. So it expedites transactions. It makes them easier and more convenient. But you have to, in order to use that money, you have to think of it as a store of value, something that has some ability to purchase the same amount of goods when you spend it as it did when you received it. If it deteriorates in value quickly, you don't want to receive it. You don't want to use it to buy goods and services, because you might not buy them for a week, a month, a year, and you need something that holds its value. So it has to be a store of value, as I refer to it. People have no interest in a money that loses its value quickly. Now, you also want something that you can carry forward, in time and transport easily. So carrying some paper bills is pretty easy. Bitcoin is even easier. You want something you can execute swiftly for low cost. Bitcoin is faster and cheaper than most monetary exchanges, particularly from one currency to another. So it offers a lot of advantages as a currency, as a money. Now, some people argue that crypto is a scam or even a Ponzi scheme. Any asset can be used as a scam or a Ponzi scheme. Some cryptos are guilty of that, and we'll look at one here shortly, FTX's own FTT. But it doesn't mean all of them are or have to be. And I go back to that, that perception, that basis of value. All basis of value is ultimately perception. And if people use some form of currency or money and it carries forward their value, they feel more and more comfortable with it. Well, Bitcoin obviously has had a larger and larger user base every year because it does the job. It carries forward the value. Now, people argue that it fluctuates in value greatly, but if you look at the price or value of Bitcoin from 1 year to 2, 3, 4 years down the road, it's only improved its value. And that's pretty attractive as a currency. Now, if you do it on a day-to-day basis or a monthly basis or even a year, over a year, there may be times when it has lost a fair amount of value. It is volatile. It's a new technology. It's still being accepted, still being understood. So it does have volatility, but if you look at it over a 3 to 5 year period, it's really only grown in value for over any 3 to 5 year period. Ponzi schemes also are dependent on fraud and misrepresentation and hiding things from people. Bitcoin hides nothing. A good DeFi crypto hides nothing. Everybody is aware of what's going on. So it really doesn't fit the classical definition of a fraud or Ponzi scheme, depending on if it's CeFi, DeFi, and how it's run. If we look at different assets that have been valuable, for example, gold. A lot of people love gold. Historically has been valuable because people perceive it to be. Lead has not been valuable because people perceive it not to be. But Can that change? Let's say circumstances change. Can the perception itself change? With new information, will your perceptions change? Suppose, worst case example, the apocalypse hits. What's going to be more valuable to you? A pound of gold or a handful of lead in the form of bullets? There's a lot of changes going on. And if you'll notice, gold hasn't responded to this latest inflation period or devaluation of the currency like it has in previous periods. So don't get stuck in the past just for the past's sake. Be able to evaluate changing perceptions. That's where you're going to find your advantages or strength if you understand and look at those increasingly over just historical norms. So Sam and FTX, how did that impact crypto? Hopefully we have everybody has a good or basic understanding of crypto. Did FTX hurt the value of crypto? Undeniably. Absolutely, positively, undeniably. One way they did it was outright fraud. Sam and FTX would, for example, sell Bitcoin. People thought they were giving FTX their money and to be invested in Bitcoin, like an exchange should operate. But we know now that FTX owned 0 Bitcoin. And so a lot of this money that was supposed to flow into Bitcoin didn't. Obviously, if that money had flown in and purchased Bitcoin, supply and demand being what it is, the price of Bitcoin would have risen. Well, taking money out of the system and denying it to the actual trade obviously hurt the price. Now, funny thing is that Sam and his main trader, Sam Trabucco, who I just call Trabucco, actually bragged about trading Bitcoin, talking about how they took all these big positions and indicating that they made money, all the while knowing they didn't own a single Bitcoin. So, if you love a picture of fraud, there you go. Sums it up pretty damn well. We also know that Sam and Trabucco implemented a trading system, a computer trading system called an API that gave them foreknowledge of upcoming trades. Now, let me explain foreknowledge to you a little bit. If you are an investor and you put an order in with a broker and it's a sizable order, well, the broker knows that your trade, when it's executed, will cause the price of the stock or the coin to move, to increase or decrease if it's a big sell. Well, they may want to try to get ahead of that trade so that they can exploit that price movement. So if you put in a big order to buy, they might actually go in and buy some of the cheaper offers and then sell it back to you and capture that spread difference. So if you put in an order for a stock at $100 a share, by the time you get the confirmation, it may read, $100.05. And you think, okay, that's cool, no problem. But the thing is, their foreknowledge, taking their position before yours was executed, made them money. And it may be a small amount. It may be a penny a share. And so you think, okay, no big deal. But do the math. If this broker is executing 1,000 shares a second, they just made $10 in 1 second. 60 seconds in a minute, $600. 60 minutes in an hour times 7 hours a day of trading time, whatever it is, depending on the market you're in. It ends up being pretty big money. But the main point is they defrauded you of money you should have had. And to the SEC, foreknowledge is illegal. It's a felony. Well, look at old Sam, in his infinite wisdom talking about, you can't, if you want to trade successfully, you need to be informed. So be informed. Well, beauty of a system with foreknowledge is it's 100% perfect. You can't be better informed than seeing actual orders and being able to jump your order in ahead of those. Foreknowledge. So, nothing like bragging about your corruption. Well, it doesn't stop there. This brainiac Trabucco, the head trader for FTX, also made some investments. For example, he bought Dogecoin. Dogecoin, a meme coin. By meme coin, I mean the people that created this coin created it as a joke. Okay. They created, I forget, 1 trillion coins, some ridiculous number. It was just started as a joke. Well, Elon Musk tweets about it sometimes, or has tweeted about it sometimes, kind of as a joke, said, I'm a believer. No, the guy's kidding. Well, Trabucco thinks he's not, so he goes out and buys it. And he talks here, he makes a tweet in April and says, we've been buying it for the past few months. Well, here's, some of the time they were buying it when it was being hyped, when Musk would tweet. And then you can tell what's happened to the value of it since. Brief little spike, but here's about where it was when BTX collapsed. About 7-8 cents a coin, whereas they were buying it at 17-18 cents. Brilliant trading. Absolutely brilliant trading. And if you don't believe me, well, here's Trabucco's own tweet where he talks about, we bet on Doge. It's all great. Noticing how it goes up when Elon tweets. So basically, Trabucco is trading off of Elon Musk tweets. You can't make this stuff up. You can't. Now, we know Alameda had some success trading like the kimchi premium, which I talked about in the last video. According to one insider, they made approximately $30 million, which isn't bad over a 6-month period in 2019. But after that, they obviously ran into difficulty making money off of trading. And with a brainiac like Trabucco heading it up, it's not hard to understand. They lost tons based on financial transactions that we're aware of. For example, they lost millions on directional bets on crypto like Ethereum. Sam directly wanted to make a directional bet on Ethereum. Now, directional bet is you're betting that the value of the asset is going up or down. It's moving in one direction or the other. And it's a kind of a short-term position and usually made with a lot of leverage. So if you bet wrong, you lose large quickly. Well, they lost big, they lost quickly. They lost millions on shit coins, little old unknown cryptocurrencies that they thought would take off, took big positions. They didn't. Maybe even dropped after they bought them. You want to know what a stupid company looks like or does. FTX lost millions on like XRP transfers. XRP is a coin, relatively widely known, accepted coin. But FTX would receive these XRP coins as payment or transfers or investments. But for some reason, they didn't really show up on their books for a while. So they didn't liquidate them and exchange them into cash, dollars, or, whatever. And the value of the coins went down before anybody noticed. So it's like somebody paying you in food, in meat, and it's laying out there on the dock, a whole pallet of it, and you kind of forget it, overlook it for a month or two. And then by the time you see it go out there, it's rotten, stinky. It's nothing but, worm food. Well, that's what was going on with FTX. They would receive these assets, not know it, not be aware of it, not liquidate them, not reposition them, do nothing. And then the value would drop down before anybody noticed. Just absolutely, totally, completely incompetent. Part of FTX and Sam's problem was they made money in a rising market. And anybody can make money in a rising market. But the problem with that is markets don't always rise. And that's when your trading ability really shows up, or the lack thereof. Taking on risk in a bull market usually is smart, but it will kill you. It'll destroy you. It'll wipe you out in a falling market. Now, by 2022, we know there was already some difficulty. There were a number of loans, quote unquote, in place, a lot of margin. And with the crash in crypto prices, FTX held some positions in what are known as stable coins. Luna and Terra were two stable coins that were kind of designed to trade off of each other and hold a relatively stable value. Well, looks like FTX lost $1 billion when those two crashed. Literally, the price went down 90% in one day. FTX obviously started getting a ton of margin calls from the credit desk, and that's when it really went in deep into, they say, borrowing customer money. It's not borrowing. You didn't have the customer's consent. You didn't sign a loan agreement. You didn't pay them interest or offer to. You stole it from them, flat out stole them. Well, so they stole the customer money, tried to cover some of the margin calls, and the dumping a lot of the FTT caused a drop in those values, resulted in even more margin calls. It just ended up resulting in a huge imbalance between what FTX owned and what FTX owed. And it wasn't favorable to FTX. Now, another problem was, as if none of this was enough, another problem is that Alameda funded a number of incubator coins. Incubator coins are coins that are just trying to get started, trying to be developed for whatever reason. There's 2,000 different cryptocurrency coins out there. Most of them are going to die off. They're worthless. But as they're getting started and initially promoted, they're called incubator coins. And one coin that they were involved in was Serum. Obviously, nobody's heard of it. But the way this works is they fund it with a small contribution, say a couple $1 million. Then they start releasing coins, but they only release a small portion of what they say they will. Now, let me ask you, I said they're releasing coins. Is this a CeFi or DeFi system? Centrally released coins all at once. It's a CeFi system. So they don't release all that they say they will, only a small portion. So the price is automatically artificially higher than what it would be. They use hidden accounts then to spend and buy these limited number of coins, driving the value up. Well, we know as the value of coins starts rising rapidly, it attracts a lot of attention. More investors start throwing money at it, trying to capture that early rise that some coins experience. And the faster it grows, the more people are attracted to it. Meanwhile, FTX kept most of their coins in their accounts, but recorded their value at the current increased market price. So as the price of the coin grows, so does FTX's balance sheet, the value of its assets. And the important part is that increased their ability to loan. So, their $2 or $5 million expense would grow to 100 or 200 million, 500 million, maybe even a billion, depending on a few factors. So off that $1 billion in assets, they could borrow 100 million or 200 million in hard cash. Boom. From 5 million to 200 million in the matter of a few months. Who wouldn't want to do that? In fact, the market even developed a name for these type arrangements, these coins that were being produced. They called them Sam coins. That ought to tell you what the market thought of them in general. But obviously, there were enough people out there that weren't aware of it, that weren't informed, who didn't do their work in trying to understand what they were investing in. So they invested money and lost it. For FTX, this type of growth in the balance sheet created an appearance of financial stability. All the while, Sam and Trabucco were making stupid bets, stupid, mindless, brainless bets, basically assuming prices always rise. Well, reality just bitch slapped them. FTX had moved away from a relatively safe and simple trade of serving as a middleman in a Bitcoin arbitrage and moved towards taking huge directional bets on shifting crypto prices. They lost and lost repeatedly. They generally used leverage, which magnified their losses. Now, as the value of their stupid bets crashed, the margin calls came in from the credit desk, and FTX had to borrow more and more from customers. Okay, let me reword that. FTX had to steal more and more from customers. All the while, Sam was hobnobbing with DC Elite, trying to convince them that FTX was the future and should be supported politically with regulatory advantages. Now, get this. Sam wrote up and proposed a standard that would favor them over competitors. And here it is. Now, I'm not going to read it all to you. It's kind of, kind of interesting. Not only is it obviously his stream of consciousness thoughts, but the point he generally makes oftentimes is that, this is the way FTX does it because we think it's the right way, and everybody ought to do things this way. So it was kind of an effort to give FTX a regulatory advantage or safe haven in terms of how they conducted business. And, being politically connected can get you regulatory advantages like that. You can put them in place. Now, Sam got his regulatory, connections or advantages not because he was all that bright or personable or had great hair. He got it primarily because his parents were extremely politically connected. His brother even was took advantage of this. His brother, for example, filed or started a organization guarding against pandemics. And by his own admission, he states, we funneled hundreds of millions of dollars in the 28 midterm elections. Money buys you influence in DC. But it doesn't stop there. His parents actually headed a relatively secretive organization. Now, his parents, keep in mind, attorneys at Stanford Law School. They headed a relatively secretive fundraising group called Mind the Gap. And they also funneled hundreds of millions of dollars in Silicon Valley donations to politicians. That's how you get access. That's how you get influence in modern politics. And that's how Sam expected to get his regulations implemented. Now, Sam was also trying to build his public image, so they spent big on marketing during this time. This is when they bought the rights to the Miami Heat arena, when they were sponsoring the F1 race car driver. And he even tried to help Elon buy Twitter, which Elon declined, said he thought something was kind of fishy with the company and the people, which let's be honest, it didn't take a brainiac to see that if you tried looking. On the flip side, you've got Kevin O'Leary of what's the TV show Sharks, testifying before Congress yesterday how it was Binance's fault. Binance, a Chinese cryptocurrency company and a competitor of FTX. How was Binance's fault that FTX failed? Nothing, not a single word about the corruption, the fraud, the misrepresentation, the double entries, the appropriating customer funds, any of that. It was just Binance's fault because they got him mad on. And don't get me wrong, I'm not a huge fan of Binance. A lot of the foreign exchanges, I just don't trust. I want my money where I know that, I can get it out without international difficulties. But, Binance didn't cause Sam and Trabucco and Caroline Ellison, the CEO of Alameda, the rest of the gang to commit the fraud and misrepresentation and make the stupid trades, all that kind of stuff. It's just, how much was O'Leary paid? What's his interest in this? It just makes me wonder. Anyway, with all the news about FTX, its uniqueness with the outright corruption and fraud, with the focus on the personalities, I just really don't see the public interest in crypto taking a hit. I don't see people necessarily blaming crypto. For the investors, I think it may actually accelerate ultimately the demand for crypto in the form of DeFi, crypto and blockchain, something like Bitcoin, combined with the increasing distrust of institutions and government and, even the US dollar with the high inflation. And don't be fooled, 7% inflation is high. We're actually still seeing double-digit increases in food. Oil's probably bottomed and has started to rise again. Natural gas is soaring as winter hits Europe and North America. So inflation is still going to be a struggle. We'll probably have like a bimodal distribution. The things that are produced that people buy, like refrigerators and cars, houses, will probably see a decline in price. But the things that you buy or need, food, energy, those kind of things will probably still increase. So don't know what the net overall effect on CPI will be, but don't expect to be able to live a whole lot cheaper in the future. The one thing about crypto to keep in mind is that it has been very tightly correlated with stocks over the past couple of years, which is unusual for it over the life of it. But this is due largely to the increasing number of funds, including ETFs, kind of like a mutual fund, so to speak, futures exchanges developing cryptocurrency products. And a lot of these were structured with leverage. So some of that is being weeded out with the drop in stock prices and the drop in crypto prices, especially with the Luna Terra collapse and the fall in crypto prices this summer and early fall. So a lot of that is kind of being weeded out and I hope reduced, allowing crypto to kind of take its own course. But the intrinsic value of crypto, the unhackable nature of it, it's safe, it's efficient, it's, every transaction is public, even though you don't know who the specific parties are. You can tell one coin is being transferred from A to B, but A is a 36-digit number. B is a 36-digit number. So you can't really, looking at that, tell who the parties are, but you can see each transaction. So there's no fraud going on. Fraud is next to impossible in systems like that. And the supply of coins, the demand for coins can't be manipulated. So it makes for a superior medium of exchange in that regard. That hasn't changed. And that will continue to generate demand for crypto going forward, I believe. So I don't see it hurting crypto. There's just too much fraud, personalities getting attention. It is, however, a lesson to investors, individual investors. to understand the nature of what they invest in and what the goal of that investment is. Try to keep a lookout for divergences from that goal or red flags. There were a ton of them surrounding FTX before it went bankrupt. People just weren't looking. People didn't care. We know crypto will be somewhat volatile, but over the long term, it's probably still attractive. So that's the overview. Next time, we'll take a look at the 8, call them fine twits, major financial people on Twitter, each one with over 200,000 followers, who were just charged with pump and dump scams. Each of these guys, like I say, had tons of followers, and one of them was quoted as saying, "We're robbing fucking idiots of their money." So that's kind of a revelation. You don't really expect that. And I'll say this: nothing I do or say I make money off of in terms of the products I talk about, recommend, or discourage, or companies or whatever. I don't receive commissions. I don't receive fees. If this channel gets big, YouTube will pay me for hosting the video, but that's independent of any specific product. If I have an investment or position or receive some sort of compensation from anything I talk about, I will tell you. I'll disclose it. But generally, I talk about, the market and stocks in general. I may, own some stocks or positions, but I will receive no compensation for anything specifically that I say or talk about, on this site. So I'm not going to be robbing people of their money. But we'll talk about that and those 8 guys next time. So don't be an idiot. Tune in, subscribe, like. Don't disappoint Chunk or Tallulah. Also, always looking for ideas of interest to you. Feel free to comment below or DM me at Twitter, Moffett on Money. My time is up. I thank you for yours.